Welcome to Solidarity Spotlight, the place where we share with you bleeding-edge stories. I'm your host, Solidarity. Let's discover what's happening today in blockchain. The cryptocurrency landscape presents a fascinating tapestry of developments today, with market dynamics shifting dramatically as institutional perspectives evolve and regulatory frameworks continue to crystallize. The digital asset ecosystem finds itself at a critical juncture, balancing between unprecedented institutional adoption and the ever-present specter of regulatory uncertainty that continues to shape investor sentiment and market movements. Bitcoin's current position near the $113,000 mark represents more than just a price point. It embodies the complex interplay between macroeconomic forces and the maturing cryptocurrency market. The flagship digital currency has been struggling to maintain levels above $115,000, reflecting broader market weakness that extends beyond the cryptosphere into traditional financial markets. This price action comes amid heightened anticipation surrounding Federal Reserve Chair Jerome Powell's speech at the Jackson Hole Economic Policy Symposium, scheduled for 10 a.m. Eastern Time today. The cryptocurrency community watches with bated breath as Powell's remarks could significantly influence the trajectory of risk assets, including Bitcoin and the broader altcoin ecosystem. The market's current state of uncertainty becomes even more pronounced when examining the substantial outflows from cryptocurrency exchange-traded funds. Recent data reveals that Bitcoin and Ethereum ETFs have experienced nearly $1 billion in combined withdrawals, marking one of the most significant redemption events in recent months. Bitcoin ETFs alone saw $523 million in net outflows, with major players like Fidelity's FBTC bearing the brunt of withdrawals at $246.9 million, while Grayscale's GBTC lost $115.5 million. This mass exodus of institutional capital suggests a broader risk-off sentiment that has gripped traditional and digital asset markets alike. The timing of these outflows, coinciding with Bitcoin's retreat from its recent highs, indicates that profit-taking mechanisms are in full swing among institutional investors who may be positioning themselves defensively ahead of potential policy announcements. The impact of these ETF outflows extends beyond mere numbers, representing a shift in institutional sentiment that could have lasting ramifications for cryptocurrency market structure. When considering that these same funds had experienced significant inflows just weeks prior, with Bitcoin ETFs posting $230.9 million in inflows on August 14th, the dramatic reversal highlights the volatility and sentiment-driven nature of institutional crypto investing. The fact that BlackRock's iShares Bitcoin Trust, the industry's largest Bitcoin ETF, reported zero flows during the recent selling pressure suggests even the most established institutional vehicles are experiencing pause in momentum. Simultaneously, the European Union's exploration of public blockchain networks for its digital euro initiative represents a potentially transformative development for the cryptocurrency ecosystem. The European Central Bank's consideration of running a digital euro on platforms like Ethereum or Solana marks a significant departure from the private blockchain approach adopted by other central bank digital currency projects, most notably China's digital yuan. This philosophical shift toward public, permissionless networks could validate the infrastructure and security models that have been developed by major blockchain platforms over the past several years. The implications of this decision extend far beyond European borders, as it could establish a precedent for other central banks considering their own digital currency implementations. The EU's approach to CBDC development stands in stark contrast to developments in the United States, where the House of Representatives has taken a decidedly different stance by incorporating a central bank digital currency ban into the National Defense Authorization Act for fiscal year 2026. This provision explicitly prohibits the Federal Reserve from issuing, developing, or even studying any form of central bank digital currency, while making exceptions for private stablecoins that operate on open, permissionless networks. The political maneuvering behind this decision reflects broader concerns about government surveillance and financial privacy that have become central to cryptocurrency advocacy in the United States. The stablecoin sector continues to evolve with Coinbase's announcement that it will list World Liberty Financial's $1 stablecoin, adding another dimension to the increasingly competitive stablecoin landscape. This development is particularly noteworthy given the political connections associated with World Liberty Financial and its ties to prominent political figures. The listing comes amid the project's revelation of a $205 million mint for its treasury, demonstrating the rapid growth potential within the stablecoin sector. However, the concentration of large holdings among institutional players raises questions about liquidity distribution and market dynamics that could influence the token's long-term viability and adoption. The institutional landscape continues to shift dramatically, as evidenced by Allianz Group's remarkable about-face regarding Bitcoin's legitimacy as an investment asset. The German investment giant, which manages $2.5 trillion in assets, has released a comprehensive report titled Bitcoin and Cryptocurrencies: The Future of Finance, declaring Bitcoin a credible store of value. This represents a complete reversal from the company's 2019 stance, when it dismissed cryptocurrencies as speculative instruments unsuitable for institutional portfolios. The report specifically highlights Bitcoin's deflationary design, decentralized governance structure, and low correlation with traditional markets as key factors supporting its inclusion in modern portfolio construction. This institutional endorsement carries significant weight, particularly given Allianz's status as one of Europe's largest asset management firms. The broader implications of Allianz's position shift extend beyond a single institution's investment thesis, representing a growing trend among traditional financial services companies toward cryptocurrency acceptance. The report's emphasis on accelerated institutional adoption, citing corporate treasury Bitcoin purchases that have exceeded ETF flows for 3 consecutive quarters, suggests a fundamental change in how corporations view digital assets as treasury management tools. The mention of university endowments, specifically Emory University's disclosure of significant Bitcoin holdings, indicates that the institutional adoption wave encompasses educational institutions seeking portfolio diversification and inflation hedging mechanisms. Binance's native token BNB has achieved remarkable momentum, reaching new all-time highs around $880 and establishing a market capitalization exceeding $120 billion. This surge places BNB as the 5th largest cryptocurrency globally, driven by a combination of factors including the growth of the BNB chain ecosystem, which now supports over 5,000 decentralized applications with a total value locked exceeding $8.1 billion. The continued implementation of automated token burns by Binance creates deflationary pressure on BNB's supply, contributing to upward price momentum through scarcity mechanisms that have proven effective in traditional and digital asset markets. The success of BNB reflects broader trends in cryptocurrency exchange tokens, where utility-driven value propositions continue to attract investor interest. The token's multiple use cases, including trading fee discounts, governance participation, and staking opportunities, create a comprehensive utility framework that extends beyond speculative trading. The proposed BNB ETF by VanEck, potentially approved by the end of 2025, could further enhance institutional access to the token while providing additional validation for exchange-native cryptocurrencies as legitimate investment vehicles. OKX's native token OKB has experienced extraordinary price appreciation, gaining over 400% in recent days following the announcement of a massive token burn initiative. The exchange's decision to burn 65,256,712.097 OKB tokens, reducing the total supply from 300 million to 21 million, represents one of the most aggressive supply reduction mechanisms implemented by a major cryptocurrency exchange. This burn, valued at approximately $7.6 billion, demonstrates OKX's commitment to token holder value creation through scarcity enhancement. The accompanying upgrade to the X-Layer network, which improves transaction throughput and reduces gas fees, adds utility value to complement the supply-side economics. The market's response to OKB's tokenomics restructuring illustrates the continued effectiveness of supply reduction mechanisms in cryptocurrency markets. The token's role as the primary gas token for the X-Layer ecosystem creates additional demand drivers that could sustain price appreciation beyond the initial burn-induced rally. However, the dramatic nature of the supply reduction and the rapid price appreciation raise questions about long-term sustainability and the potential for regulatory scrutiny similar to previous token burn events in the cryptocurrency space. Market sentiment indicators reveal a complex picture of investor psychology, with the Crypto Fear and Greed Index declining from 50 to 46, signaling growing caution among market participants. This shift toward fear reflects the uncertainty surrounding Federal Reserve policy decisions and the broader macroeconomic environment that continues to influence cryptocurrency pricing. The synchronized movement between traditional equity markets and cryptocurrency prices demonstrates the increasing correlation between digital assets and conventional financial markets during periods of uncertainty. The technical analysis landscape presents mixed signals across major cryptocurrencies, with Ethereum maintaining an ascending channel pattern that has characterized its bull run from April lows, while Bitcoin has broken out of its bullish channel, indicating a resurgence of selling pressure. This divergent price behavior suggests that Ethereum may be positioned for potentially larger gains if Federal Reserve Chair Powell adopts a dovish tone in his Jackson Hole remarks. The options market reflects this uncertainty, with Bitcoin options suggesting approximately 2% price volatility over the next 24 hours, indicating slightly above average expected price movements around the Jackson Hole event. Derivatives market dynamics reveal additional complexity in current market positioning, with the 30-day delta skew in Bitcoin options reaching 12% this week, a 4-month high that reflects increased demand for downside protection. This positioning suggests that sophisticated market participants are hedging against potential negative outcomes from policy announcements or broader market deterioration. The elevated hedging activity, combined with significant open interest increases in both Bitcoin and Ethereum options markets, indicates that institutional investors are preparing for volatility while maintaining exposure to potential upside movements. The global regulatory environment continues to evolve in ways that could significantly impact cryptocurrency markets, with the European Union's digital euro exploration representing a potential catalyst for blockchain infrastructure adoption. If the EU proceeds with implementing its CBDC on public networks like Ethereum or Solana, it could validate these platforms' scalability, security, and regulatory compliance capabilities on a massive scale. Such validation could attract additional institutional interest and potentially influence other governments' approaches to digital currency implementation. The corporate treasury adoption trend continues to gain momentum, with public companies purchasing approximately 131,000 Bitcoin in the second quarter alone, according to institutional adoption data. This sustained corporate demand, which has exceeded ETF flows for 3 consecutive quarters, suggests that businesses increasingly view Bitcoin as a legitimate treasury asset capable of providing inflation protection and portfolio diversification benefits. The integration of digital assets into corporate treasury strategies represents a fundamental shift in how businesses manage cash reserves and approach long-term value preservation. Educational institutions are also participating in this institutional adoption wave, with university endowments beginning to allocate portions of their portfolios to cryptocurrency investments. This trend, exemplified by Emory University's disclosure of significant Bitcoin holdings, suggests that even conservative institutional investors are recognizing the potential benefits of digital asset allocation. The participation of educational endowments, which typically maintain long-term investment horizons and conservative risk management practices, provides additional validation for cryptocurrency's role in institutional portfolios. The stablecoin sector's continued evolution reflects the growing demand for digital dollar alternatives that can operate within the cryptocurrency ecosystem while maintaining price stability. The listing of new stablecoins on major exchanges like Coinbase demonstrates the platform's commitment to providing users with diverse options for dollar-denominated digital assets. However, the concentration of stablecoin market share among a small number of issuers raises questions about systemic risk and the potential need for regulatory frameworks that ensure adequate reserves and operational transparency. Layer 2 scaling solutions continue to gain traction as blockchain networks seek to address throughput and cost limitations that have historically constrained mainstream adoption. The development of specialized Layer 2 networks focused on specific use cases, such as DeFi applications and real-world asset tokenization, suggests that the cryptocurrency ecosystem is maturing toward more specialized infrastructure that can support diverse applications and user requirements. The intersection of traditional finance and cryptocurrency continues to deepen, with major financial institutions increasingly offering cryptocurrency-related services and products. This trend extends beyond simple custody solutions to include sophisticated trading infrastructure, lending services, and structured products that cater to institutional investor requirements. The development of this institutional infrastructure creates a foundation for sustained cryptocurrency market growth while potentially reducing volatility through improved liquidity and professional market-making activities. Market microstructure continues to evolve as institutional participation increases, with improved liquidity across major cryptocurrency pairs and reduced bid-ask spreads that benefit all market participants. The professionalization of cryptocurrency trading, evidenced by the growth of algorithmic trading strategies and sophisticated risk management practices, suggests that the market is transitioning toward a more mature and efficient state. The geopolitical implications of cryptocurrency adoption continue to unfold, with different jurisdictions taking varying approaches to regulation and integration. The contrast between the European Union's exploration of public blockchain networks for CBDC implementation and the United States' legislative efforts to ban federal CBDC development illustrates the complex regulatory landscape that continues to shape cryptocurrency market development. These jurisdictional differences create opportunities for regulatory arbitrage, while potentially influencing where cryptocurrency innovation and adoption occur most rapidly. As market participants await Federal Reserve Chair Powell's remarks, the cryptocurrency ecosystem stands at a crucial inflection point where institutional adoption trends, regulatory developments, and macroeconomic policy decisions converge to shape future market dynamics. The continued evolution of cryptocurrency infrastructure, combined with growing institutional acceptance and regulatory clarity in certain jurisdictions, suggests that the digital asset ecosystem is transitioning toward a more mature and integrated role within the global financial system. The current market environment reflects the complexity of forces acting on cryptocurrency prices, from institutional adoption trends that provide fundamental support to macroeconomic uncertainties that drive short-term volatility. This dynamic tension between long-term structural growth drivers and near-term risk factors creates both opportunities and challenges for market participants across all segments of the cryptocurrency ecosystem. That concludes today's Blockchain Spotlight. I would love to know your thoughts. Thanks for listening, and don't forget to follow me for more spotlights. See you next time.